In this video, we're going to be performing a deep dive on VF Corporation's dividend safety. To begin, let's talk about VF Corporation's business model. VF Corporation is the largest apparel manufacturer in the world. The company's brands include the North Face, Vans, Timberland, Lee, and Wrangler jeans. VF Corporation has been in existence since 1899 and generated more than $12 billion in sales in fiscal 2017. The company employs more than 65,000 people and has a market capitalization of almost $33 billion. VF Corporation is a well-known dividend stock because of its compelling track record of dividend growth. With 46 years of consecutive dividend increases, VF Corporation is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. Looking ahead, investors cannot rely on VF Corporation's dividend history alone to measure its dividend safety. The company's above-average dividend yield has also led some cautious investors to question the safety of its future dividend payment. For the remainder of this video, we will discuss the company's current dividend safety from four perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss VF Corporation's dividend safety in the context of the company's current earnings. When VF Corporation reported third quarter financial results on January 18th, the company announced that it generated $1.30 of earnings per share in the 3-month reporting period. For context, VF Corporation currently pays a quarterly dividend of 51 cents per share, which implies a payout ratio of 39% in the most recent quarter. Looking at over a longer time horizon, our conclusion is the same. VF Corporation's most recent financial guidance calls for adjusted earnings per share of $3.73 in fiscal 2018. The company should pay out $1.89 of common share dividends during the same time period for a full-year payout ratio of 51%. Using earnings, VF Corporation's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. With that in mind, we will now compare VF Corporation's current dividend payment to its free cash flow. Through the first 9 months of fiscal 2018, VF Corporation generated $1.4 billion of cash from operating activities and spent $195 million on capital expenditures for free cash flow of approximately $1.2 billion. For context, VF Corporation distributed $565 million of common share dividends during the same time period for a free cash flow dividend payout ratio of 47%. Using free cash flow, our conclusion is the same as when we use earnings to measure VF Corporation's dividend safety. The company's dividend appears very safe for the foreseeable future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. With that in mind, this section will analyze VF Corporation's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. VF Corporation's performance during this time period is shown here. VF Corporation performed surprisingly well during the last recession. The company's earnings per share declined by just 4% peak to trough. Because of this, we have no concerns about the company's ability to pay rising dividends during future economic contractions. The last angle that we will use to assess VF Corporation's current dividend safety is by looking at the company's debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before the company's free cash flow will no longer cover its dividend payment. Through the first 9 months of fiscal 2018, VF Corporation generated $73 million of interest expense and had $2.1 billion of debt outstanding for a weighted average interest rate of 4.6%. The following image shows how changes to VF Corporation's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As the image shows, VF Corporation's weighted average interest rate would need to rise to above the 25% level before it would not be capable of covering its dividend payment with free cash flow. Because of this, we have no concerns about the impact of the company's debt on its dividend safety moving forward. Thank you for watching today's video, which performed a deep dive on VF Corporation's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you are interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.